Have you ever pondered about the magic formula that wealthy people use to keep on expanding their wealth? It's a question that has tickled the curiosity of many. After all, who doesn't want to unravel the secret recipe to financial success? But what if we told you that the answer is not shrouded in mystery, but rather in plain sight? The key to financial success lies not in a magic formula, but in a fundamental understanding of two basic financial terms. And these aren't complicated Wall Street jargon, but simple concepts that anyone can grasp. These two concepts are the building blocks of every financial decision you make, whether you're a seasoned investor or just getting started on your financial journey. They're the silent heroes that can either make or break your financial future. They're the stepping stones to financial independence and the keys to unlocking the door to wealth creation. Well, it is no magic, but a simple understanding of two basic financial terms: assets and liabilities. Scene script. Let's dig into the first term, assets. What springs to mind when you hear that word? Well, in the simplest terms, assets are things that you own that have value. They're like the players on your financial team, working for you to score big in the game of wealth. Think about cash. It's a basic asset most of us have. It's ready to spend, and it's waiting right there in your wallet or bank account. But assets aren't just limited to cold, hard cash. Consider stocks. When you purchase shares in a company, you own a tiny slice of that company. That's an asset too. And if the company does well, your slice of the pie can grow in value. Let's not forget bonds. When you buy a bond, you're essentially lending money to an organization. In return, they promise to pay you back with interest. That interest is income, and the bond itself is an asset. And then there's real estate. Whether it's the house you live in or a rental property, it's an asset because it holds value. If properties in your area increase in value, so does your asset. Plus, if it's a rental property, it brings in income. So assets are not just what you own, but they are your financial soldiers marching forward to bring in more money. Now, flip the coin, and you'll find liabilities. What do you think liabilities are? Liabilities, in the simplest of terms, are the complete opposite of assets. But don't be fooled by the term. It's not as menacing as it sounds. In the financial world, liabilities describe anything that you owe. These are your financial obligations that you're responsible for, the ones that pull money out of your pocket. Imagine you have a student loan, or a mortgage on your house, or even that pesky credit card bill that shows up every month. These are all examples of liabilities. They're the debts you have to pay, the bills that keep showing up in your mailbox. But remember, not all liabilities are bad. In fact, some can even help you grow financially. Taking out a loan to start a business, for instance, is a liability that could lead to more assets in the future. However, it's crucial to manage your liabilities wisely. You don't want to be drowning in debt, do you? So keep an eye on your liabilities, understand them, and make sure they're under control. In the grand scheme of things, the goal is to have your assets outweigh your liabilities. That's how you build wealth. So keep this in mind as you navigate your financial journey. In essence, liabilities are the financial holes in your pocket that keep draining your hard-earned money. So assets bring in money and liabilities take them away. But is that all there is to it? Not quite. Think of it like a game of seesaw. On one side you have assets, the heroes of our story. They work tirelessly, generating income and adding value to your financial portfolio. They are your savings, investments, real estate, and anything that puts money into your pocket. On the other side, we have liabilities, the villains. They are the loans, credit card debts, and expenses that drain your resources. They are the weights that keep your financial seesaw unbalanced. So, what's the trick? Balance. The goal is to tip the seesaw in favor of assets. The more assets you have, the higher your wealth climbs. Conversely, the more liabilities you pile up, the lower your net worth sinks. Remember, the key to growing wealth lies in increasing assets and decreasing liabilities. So, are you ready to start your journey to financial freedom? Let's take one last look at what we've learned. Assets, the things you own that bring value to your life. These could be investments, real estate, even your knowledge and skills. They're the building blocks of your financial fortress. Then there are liabilities, obligations that drain your resources. They could be loans, credit card debt, or even a mortgage. They're the holes in your fortress wall that let the wealth seep out. Understanding the difference between these two is the key to building a robust financial future. It's about increasing assets and decreasing liabilities. Remember, your financial journey is a marathon, not a sprint. It takes time and patience, but with determination, you can shape your financial destiny. Empower yourself to achieve your financial goals. Don't forget to subscribe for more empowering financial content. Keep learning, keep growing.